And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Anytime you're talking about fundamentals in a market and direction, fundamentals take a little bit of time to play out.
We got crude oil today, kind of trading yesterday's value area really nicely, low to high.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everyone. Welcome back to the Coach's Playbook. We're here with some of the usual characters: Danny Hodgman, Mick Aronimal, John Hoagland. I am JD, filling in for Jack again, who is still on paternity leave. I guess those babies need quite a bit of care nowadays, huh?
Well, TLC.
Best wishes to Jack if he's listening right now. Well, today we are going to be talking about the cardinal rules of trading. I pulled up a definition about what a cardinal rule is, and it is a rule that is so important that if you break it, there are dire consequences. Does that make sense to everybody?
Makes sense to me.
Well, before we get going any further, let's first, Mick, I didn't check you to see if you had a Fund to Trader shout out before we came live, but any chance you do?
I always do, JD. So today, big shout out to Braden Casella. He is up $2,500 trading the NASDAQ this morning.
Boom.
Strongest equity indices or index on the board right now.
Nice job, Braden. I hope you're listening. Well done. So in trading, it's good to have rules and set limits. What do you say we just kind of go around the turn like we usually do and throw out some of our best takes? Mick, I know you hate going last, so I'm going to pick on you and call on you first today. How do you feel about that?
I love it. Thanks, JD. Finally prioritized ahead of these guys that I'm on here with. So there's a lot of cardinal rules, and I think when you think about rules for your trading, you've got to start somewhere, and that's reading up on rules that other people who are in the industry like to follow. So find someone that's intelligent and profitable in this industry. Listen to what they're doing, but you also need to formulate your own rules for yourself. You know yourself best, so certain people have different personalities. They're going to act certain ways, especially when it comes to emotions being involved. So you really want to formulate your own rules. And as a trader, you're not going to be able to just, before you even start trading, lay out all these rules. The rules that you're going to come up with, it's going to take a little time to put them together. You should, like I said, follow the good rules that certain people have already, mentioned that they follow, but you need to tailor your own rules. And, I think it's a learning process. It's a long process. It has been for me. I'm still coming up with new rules to put on my own trading. And, I think first and foremost, one rule is, and this will probably help anybody from, just getting started to someone who's been trading for a while, which would, any of those people would probably agree with me. And that is, you don't have any business losing more money in a single trading day than you put up on, an average winning day. I've talked about this before. We've talked about this before. If I make $400 on average on my winning days, sure, I'll have some more winning days that are larger than that, some that are lower. But if I'm a $400 a day average winning trader, I don't have any business losing more than $400 on any given trading day. You want to be putting yourself in a position to, have multiple losing days wipe out a single winning day's profits. You don't want to be on the other side of that, where you have one big bad losing day and it takes you 1 week, 2 weeks, maybe even more to make up for that. So this rule boils down to money management, and the rule is you don't have any business losing more than you can make in a day.
Yeah, and I think that's probably one of the hardest rules to actually follow. You could break it down into more smaller rules too, like 3 losing trades in a row, go take a walk or get out for the day. Set your set your daily loss limit and stick to it. Maybe call your risk manager and tell them to just cut you off when you hit a certain point.
Yeah,
And I
I
like
think
the
it's. Go ahead, finish what
Oh
you're
no,
gonna
I'm
say.
sorry. Please.
I was just going to say it's a hard rule to follow if you get emotional because
Mhm.
people start panicking when the market's going against them. They freeze. They say, "Oh, I should get out," but then they start hoping that it goes back to break even or in their favor. But if you have predetermined levels, dollar wise where you need to get out or a predetermined level in the market, it is what it is. You got to cut it off there. And it's that much easier to come in and sit down the next trading day and find more opportunities. So it can be tough if you're emotional, but the more you plan out every single trade, know where you're getting out if you're wrong, know where you're getting out if you're right, then it's not going to be that difficult. You might not like it, but you're not always going to be comfortable trading.
100% true. And I
Sorry
love
to cut you off, JD. There.
No problem. I was just going to comment that the first point that you made, I've been hearing that my entire career. If you're going to follow somebody, if you're going to be piggyback somebody, make sure they're smarter than you and make sure they are a winner. Those are those are cardinal rules right there.
Yeah.
Oh, what do you think?
Oh, I agree with that one wholeheartedly. As a matter of fact, number 9 on my list of cardinal rules is think for yourself. Never take tips from anyone. Own your own trades. But the cardinal rules are, we all worked on the trading floor. We all saw and we all had a dirty, pencil written trading card with some basic rules for us to kind of follow for ourselves. We learned from other people. Not all cardinal rules are going to work for everybody. It's just an outline of things that we want to make sure that we don't do. Now, I have cardinal rule number 1 and cardinal rule number 2 right in front of me here. I was guilty of this early last week. I believed that the S&Ps needed to continue to the downside before they could continue the move to the upside. Prices do not have to do anything that we want them to do. They are going to do what they are going to do. So rule number 1, prices don't have to do anything. I stood next to guys in the S&P pit. We're like, S&Ps are going down today. I'm going to be short all day long, and they're going down. I know it. It has to go down, and watch the market rally on them all day long. Prices don't have to do anything, and that's cardinal rule number 1. Cardinal rule number 2, see cardinal rule number 1.
It's the truth. The markets are infallible. You could be wrong every single day, but the market is never wrong, right?
Mm-hmm.
Yeah, I think it's good to have a bias on direction, or on certain days no bias on direction. But if you're saying it's going to go here, or it has to go here, I mean, it doesn't have to do anything.
And that's what puts you into that position where you're so confident and so sure you're probably over leveraged. And if it doesn't go, you're going to have a real bad day. And I've had really bad days because of that bias that the price has to do this today.
Which leads into another cardinal rule. Never add on to a loser, right?
Losers average losers.
Dan, what's your take on it?
Well, I'll be completely honest with everyone out there. I do add to losers. I have structure around how I do it. It's not just because the market's going against me. I'm going to leverage in and hope for just a better average price to then maybe get my, recoup some of my losses. I do average into losers. I have no problem with it as long as I'm doing it within inside of my system, right? I'm not coming out the gates fully swinging on max load right away. I'm getting in a little bit. I'm testing the water, waiting to see how that market reacts to where I got in. If it starts to go against me and I still continue to see my levels working, I'm okay with it. I have no problem going from 1 to 2. If I have to continue to build, I have structure around how I add to losers. I don't add to losers when the market's ripping against me and me just going, screw it. I'm putting another 5 lot on. Like, let's just see if we can really average in better. No, that's not how I do it. But I will be honest with everyone. I know it's one of the biggest Cardinal rules out there. But I will also I'm a pretty honest guy. And I will say I do it within certain structure.
Mick's
Dan-
loaded up for you. He's loaded up for you right now. He's coming for you.
Mick's coming swinging.
No, I'm not actually, because I know where you're coming from when you say that, Dan. And I just want you to clarify it for the rest of our audience. When you talk about adding to a loser, you put a little bit of your position on, then you add to it. You're talking not just about adding to a losing trade, but you have a bigger time frame bias where you like going long in a certain zone, which is comprised of multiple prices. So you're not going, you know, if the market comes back down to the zone where you want to buy it, you're not just buying, you know, your full position sizing. You're putting a small bit of your position sizing on. And while it maintains in that zone, even if it goes against your first little buy, you're adding to a position that you still feel strongly about in a certain price area, not just adding to a loser to add to a loser, hoping it comes back in your favor.
Correct. Like, for prime example is, let's say you've got settlement price down below. You're looking for market to stay inside. Market is still setting up really nicely inside. You've got settlement price. You're trading S&Ps. Market comes down to settlement price. You got point of control a couple points below that. And let's just really throw it all out there. And like 2 points below point of control, you have prior day value low. So you've got 3 levels, simple levels that we talk about all the time down below that you're looking at. The first thing I want to do is, hey, I like this area. I don't want to miss my trade if settlement is as low as it gets. I do have 2 more points down below that I can look to kind of average or leverage into this trade. All I'm doing is I'm just taking advantage of the location that the market's in. The second it breaks outside of that and changes from market state from staying inside to breaking out to the downside is when I'm jumping out and saying, all right, I'm out. This is no longer the trade. I'll take my loss. But really all I'm doing is I'm looking at an area. And if I have multiple points within that area, I don't want to miss the move. So I'll take the first step. I'll get into it. I can be small. And if it recovers right away and rotates back inside and rips higher from there, great. I took my small position. I got a nice move. If I can continue to build in as it gets lower and lower to my extreme, then I'm able to really build on it. So I appreciate you pointing me out there, Mick. I think it needs clarity. It's not just, hey, the market's going against you. Crude oil's down big today, right? We're continuing lower. It's not like, you know, you buy at $83, then you're buying at $82.50 or $82.75, and you just continue to see this thing make new lows, and you just continue to buy and hope you're going to get the little bounce. It's a lot more to it than that.
Yeah, there's a big difference between accumulating an inventory in a zone and burying yourself, because if you liked them at 8, you'll love them at 7. You'll like them more at 6. You'll really like them at 5. At 4, you're going to buy more, even though you're a little worried. And at 2, you're puking out.
Yeah,
absolutely.
I'm glad we clarified that. And one other example, you know, just to maybe help the viewers even more so, is like you mentioned crude oil, Danny. It's trading $82.50 right now. Let's say you liked going long, you know, under $83. Well, it's trading $82.50 right now, and you like the buy zone of anywhere from $82.50 down to $82 a barrel. Maybe you put a quarter unit on here at $82.50. We trade down to $82.30. You put another quarter unit on. The market's gone against you from your first buy, but you're not panicking because you like this area for a higher time frame trade. And then it goes down to $82, and maybe you put another quarter unit on or something, and then see what happens. Now you've almost got a full unit size on there, with, you know, hopes of it, you know, going higher. So that's kind of how it works, adding to, you know, I almost don't even like calling it a losing position, because you're just accumulating a position in a certain zone.
We've got David Robles actually puts a good language around it. He was just kind of asking, what's the difference between of not adding to loser or adding to weakness? I think that's kind of a good way of putting it. You're adding to the weakness in the market. Hey, you're waiting for this market to recover from here. You're able to continue to add in as we get a little weaker, looking for that recovery. And as long as you're doing it within certain structure of something you pre-plan, you don't just hop in and start loading up on it. So I think there is a natural balance we have to have. And if you're a 1 or a 2 lot trader, adding in is not going to be really beneficial for you. If that's the style of trading you're going to do, or if that's how the appetite for risk that you have, doing this is not that beneficial.
Yeah. And if you're trading off, if you're making your trades off 5-minute charts, then that's probably not for you too, because your zone is so much smaller if you're looking, at a 5-minute chart for shorter time frame plays.
I got a little warning sign for those that might be thinking that they're adding on to losing positions or accumulating an inventory in a zone. When you start thinking about moving your average trade price lower so you can get out of this trade at a scratch, you're in trouble.
Get out.
100% correct.
Yeah,
Don't get me wrong. When I do it, I like seeing that average price, look a little better. Don't get me wrong. I enjoy that, but that should not be your mentality. And I do want to add one more cardinal rule that I have for myself. I keep multiple mouses. I don't know what the right terminology is. But if one doesn't make it and I have to go to the next one, stop. That's a key sign that today is not a day. Get out and move on. We used to have, I remember back at the old firm I was with, we had a desk, we had an office, or in the closet in the office, we had a stack of just computer mice sitting there. And you would see one guy go in and he'd grab one. And I'm like, oh boy, here comes a day. And you'd see him get up and he'd grab another one. And now he's burned through 3 mice in one day. Finally, someone would walk up to him and be like, hey man, I think you've hit your limit and your budget for the day on computer mice. Let's get the hell out of here and just move on. Like, we'll cover your position. Go home, please. Like,
you owe us a lot of money for those mice you killed.
We don't want to see any more of this. We're going to cover your position for you. You don't even have to get out. Please just walk out of this room and don't come back today.
Funny how those things can just fly off the table sometimes, right?
Well, it's funny, sometimes you don't think your grip is that strong on it. And as you hit the desk a little bit and all of a sudden it's like, oh, why did that just crack? I didn't do anything aggressive to it.
Yeah,
may have done it a couple
weeks
ago.
Should try and stay out of those situations where you're getting that worked up. If you're getting angry or frustrated, it's best to walk away.
Mm-hmm.
That's a cardinal rule.
That's a cardinal rule. So let's wrap it up here. We've been on 20 minutes. Yeah. So just a few more. Know the market that you're trading inside and out. I got to say, know where you're getting out of a trade before you get into it. Always trade with a stop. What's another great one? Oh, if you're a day trader and you're thinking about going home with a losing position, you better think again. It's never good to have too rigid of a bias. You need to be flexible. If the market is proving you wrong, you need to get out. Don't take a trade home. If you've never done it before, don't take a trade home. That's a loser. It's probably just going to become exponentially worse. Mm-hmm. Anybody else want to add anything?
Is anxious.
Yeah, I've got a couple of things to add, and JD, if I may, well, I'm going to. I shared with you that article that I wrote, the old school rules that still hold true, and I know you mentioned you're going to get those posted on the blog. These are, I put together a little list of, good rules of thumb when it comes to trading. So I know JD is going to get that added to our blog sometime in the very near future. So definitely check that out. The last thing I want to mention is, we're all here trading to make money. So this is going to sound kind of odd, but you need to separate your desire from profits from your trading. You really need to just trade the markets that you see and not be trading your P&L, trying to hit, old P&L highs from the day, that kind of thing. So separate your desire for making money from your trading. And there will be more on that little one in this blog post that we're going to have.
I think that goes with like my number one, focus on the process over profits. If you focus on the process, the profits will follow. If the profits don't, then you're learning something and you have to make some changes. Yeah,
definitely. Making money is a byproduct of good trades. Taking losses, byproduct of bad trades, so focus on the process, like Dan says, and you're going to get your outcomes one way or the other.
Wonderful. Thank you for that. And yes, Mick's article will be attached to the replay video for this little chat we're having. So look out for that. You'll see it on the weekly kickoff for sure. With that, Dan, did you happen to come up with a quote for us?
I do. It comes from Mr. Cliche himself, Jim Cramer. If you've ever listened to him, he's got a lot of cliches. I like this one though. Hope is a bogus emotion that only costs you money.
I agree with that.
Not a
Very
strategy.
Wonderful. Thank you, Dan. Hogue, want to take us home here?
Sure. Yeah. Thanks for joining us, everybody, today. One last thing I want to say is don't ever become the accidental trader. If you fat finger something, if you put something on that you didn't mean to put it on, don't think back. Don't sit back and say, maybe this will work. Just get out of it. Give up the couple of ticks, get back to your operations, and we'll see you next time. Trade well.